Another week, another video. This video is literally about ISAs versus pensions, which you should be using, what combination, and a couple tips around mistakes that I see a lot that will literally cost you thousands of pounds if you expletive it up. So I want to make sure that you understand the differences, the key considerations, and not to make really common mistakes, because life is, especially at this stage, is quite dangerous to make those mistakes, as it's very costly. I'm Ryan, I'm a chartered financial advisor, planner. I've been doing it for about a decade, so I like to think I know what I'm talking about, and I've been doing these videos for a little while now. Your pension is better than your ISA. We can have a debate about it. I will happily meet you in the streets and we will talk about it, but your pension is by far better. Think of it as like this massive funnel, okay? The money going into your pension is incredibly tax efficient because there's no tax to pay. Like, there's no income tax, and sometimes there's no national insurance, depending on how your employer set up the contributions or you set up the contributions. And your employer will give you free money, which is unheard of in any other country, really. The other thing is that if you own a business, you save on corporation tax. If you whack £60,000 into your pension, you save 19%, which is £11,400 in tax, because it's seen as an expense. Then the money gets to grow in a very tax efficient way. So there's no capital gains tax and there's no dividend tax that are paid within that pension, that stay within the pension whilst it's still in accumulation phase. It's only on the other end that the tax is a bit more painful, but you get to control that flow of the tax. You get to take or choose how much tax-free cash you take and choose how much taxable income you take and at what point you want to take it. So it really gives you a bit of freedom, and it takes a bit of getting used to when you're used to actually just receiving a check every month for the last 40 years through employment. So it takes some getting used to it. The other mistake, and this does cost people not thousands, but it takes ages to correct, is that when you take money from your pension for the first time, not the tax-free cash, take tax-free cash, no problem. But when you take taxable income from the drawdown account, as it's called, from the crystallized fund, which is a very fancy name of saying taxable, HMRC, in all their non-existing wisdom around it, will assign an emergency tax code. So I'd recommend or suggest, I don't know you personally, so it isn't a personal recommendation, that you take a small taxable lump sum from your pension when you need to take it, just so HMRC set a tax code for that tax year. And you have to do it kind of every year, because HMRC will think if you take £10,000 of taxable income, HMRC will think you're taking £10,000 every single month for the rest of the year. And they'll charge you, really high tax, which is horrific. And you spend a bit of time figuring out how to do a self-assessment and how to claim it back. And it's a bit of a headache. And if you needed that money for a specific purpose because your timings were off, for lack of a better phrase, then it can be really stressful. And I don't want that to be your situation. Your ISA, the money going into it is the other side of the funnel compared to your pension. The money going into your ISA is incredibly inefficient tax-wise because it's taxed money, but it is very good, same as a pension, for accumulation, for growth, because there's no tax on it. And then unlike a pension, your ISA is not taxed on the money coming out of it, but also it's not locked in. There's no lock-in period. So your pension, you've got to wait till you're 55, 57, which is still a whole decade sooner than your state pension. But when we're talking about pension and retirement specifically, most people retire at 60, 65, which is way over the private pension access age. So for that argument, considering you can control the income, I think your pension, you should be looking to access first, or at least get personal advice around that. But your pension, you want to use it first, because you want to give your ISA as much time as possible to really compound, because you don't pay any tax on it. Whereas your pension, there is a bit of a clock on it because the tax. And that's it, really. It's really understanding the balance between the two. The other key consideration, which costs people thousands of pounds, if I haven't made it clear enough already, is that when you're taking money from your private pension and you control that flow of income and you've got your state pension, if you're going to start taking income around or above £50,000, it's going to push you into the high rate tax bracket. So you really want to start using your ISA to avoid that 40% tax, because you can just take money from your ISA to top up your income as necessary and not pay any tax. That's the only bit of information I think is really worthwhile. But using your pensions first, in 99% of my cases I've dealt with in my career, makes sense for most people. And I'll catch you in the next video. Drop a comment if you've got anything you disagree with or you want me to make a video on.